Welcome everybody to this research seminar, and we have a very finance topic today is bond hedging effectiveness. And I understand that this is about the core movement between the bond market and the stock market. It reminds me of the days when I did my PhD. I was told that they go in the opposite direction. But now we are talking about a core movement. So the bond market actually moves together in the same direction with the stock market and vice versa. And that has a lot of implications for risk management, portfolio investment, because the bond market, particularly government bond, is very often taken as a safe place for people who sold off in the stock market and they go to bond market. But if the both markets are moving together, then the bond market lost that feature. So this is why the topic is so important, is so relevant, given the current uncertainty, a lot of issues. So that's basically the background of this topic. But I think Ioanna is going to introduce a new methodology, the data that she has been working on from analyzing text, documents, and deriving a measure of the so-called media coverage or disagreement, and how this type of behavioral aspect of participants in financial market will change the investment strategy. So Ioanna, actually, I know Ioanna years ago because Ioanna had, when she was doing her PhD in Burbank, our neighbor. So she worked with us teaching tutorials for some time, and now she is a proper associate lecturer of this department, and she actually teaches multiple modules. So I hope you enjoy, and we are always here to help if you have any questions. And as you can see, Ioanna has already published, and Ioanna just defended the end of last year, but she has already published in a journal, and Journal of Financial Markets, and also she's now working on the topic of core movement between the bond market and the stock market, and together with this new media measurement. I'm surprised to see that Ioanna has already set up a data set which focuses on the media coverage for female scholars, researchers, let's say. And that is already, that was sponsored by American Finance Association, Journal of Financial Economics, and now the data is hosted by them permanently. And that is really, really interesting. I just wonder, maybe we can all go to the website and looking at the data, and particularly the coverage, media coverage for female economist, financial researcher, and that is extremely interesting. So Ioanna, as I said that, you have 45 to 50 minutes presentation. Just take your time, and if we have some questions in between, I would allow the interaction, and you agreed on that. And thank you, Ioanna. The floor is yours.
Thank you so much, Bo. Thank you. So, hello everyone. I'm Ioanna Lachana, and today we'll talk about bond hedge effectiveness. So essentially, I will talk about when and why bonds do or do not protect an equity portfolio. So here, the core idea of this research is very simple. So the stock bond relationship is not constant. but it's time varying. And that exactly specification, that this time varying component matters a lot for diversification, for risk management, or portfolio allocation. So I will show evidence that the media tone, specifically the pessimism of the media, and also the disagreement between different media sources affect this bond hedge effectiveness. So here is the structure of the talk today. First, I will show you my motivation and the research questions, the data I used, and how I build the text-based measures, the pessimism and the disagreement index. Third, the main results using a conditional hedge model. Then I will move to hedge regimes and predictability. And finally, I will show some portfolio applications, and I will wrap up with the takeaways. So let me start with a graph. Because this graph shows the whole puzzle, the whole story very quickly. So this graph presents the 22 trading days rolling stock and bond correlation from 2007 to 2024. So for stocks, I used the S&P 500. I will show you later. I will explain later about the data. And bonds, the 10-year Treasury, US Treasury bond. So this is the correlation, the stock and bond correlation from 2007 to 2024. So the key thing here is that the correlation is not constant. It moves around a lot. Most of the period here, most of the times here, the correlation is negative here. And this is negative. The most of the period, the correlation is negative, which is what we hope for. Okay, so when stocks go down, bonds help. But if you see, sometimes the correlation climbs towards zero, and even the correlation turns positive. So this protection starts to disappear. So the problem, the core problem here is not, the core question is not, do bonds hedge equities? We know that bonds hedge equities, but the real question here is when. When do they hedge, and when do they stop the hedging? So this is the most important thing here, to answer this question, when. So this is very important because if that relationship changes, a portfolio that looks diversified on paper can suddenly stop being diversified at exactly the wrong moment. So back to Markovits, the portfolio diversification relies on negative correlation. So historically, this correlation is negative, but not always. Why? Most of the empirical research, the existing literature, focus on macroeconomic explanations. So, for example, Camber and Nummer focus on inflation, growth, interest rates. These three components are the most important components that affect this co-movement. But there are some gaps here in the literature and in the macroeconomic factors. These factors do not fully explain recent regime shifts. So I will go back to this graph. So here, for example, we have these spikes here in 2011, 2013, this period after 2021. So let's focus on this period. So here, this period, we have an increased inflation, but also during this period, we had an elevated volatility in the market. For example, we have the Ukraine-Russian war. So we don't know exactly if the increased inflation is only the most important thing for this regime, because here we have this regime, a change in regime from negative to positive. So this we don't know exactly if this positive correlation here is about the increased inflation. So I bring in a behavioral perspective, and that is investor sentiment. The investor sentiment captured through the media tone. So I will try to explain, and I will try to see if the investor sentiment extracted from media, from social media and traditional media, help explain this co-movement. So I have these three specific research questions. So the first question is if the media pessimism help explain this time-varying stock-to-bond co-movement. Also, I introduced the disagreement across different sources, and I will try to explain if the disagreement amplify this effect, the effect of the media pessimism. And the third question is, can we predict the hedge regimes? Because this is, at the end of the day, this is the most important thing. If we can predict the hedge regimes, because if we can predict the hedge regimes, this component can improve the portfolio allocation. It can improve our portfolios. So, at high level, I found that, first of all, the higher pessimism is associated with more negative stock and bond relation. The disagreement also plays an important role. The disagreement between different media sources amplifies how pessimism maps into co-movement. And finally, I found that a regime-based strategy can improve the risk-adjusted performance. I compare regime-based strategies with the static benchmark, equally weighted, 50-50. And I found that a regime-based strategy can indeed improve the risk-adjusted performance. Very quickly about the literature, the existing literature. As I mentioned before, there are two streams. So on the one hand, we have the fundamental, the macroeconomic stream. So this stream argues that the fundamentals affect this relationship, the stock and bond relationship. So the first stream argues that only these fundamentals, inflation, growth, real rates, affect the correlation. And on the other side, the second stream argues that the sentiment shifts risk appetite. And this shift can move the investor sentiment can move capital between risky and safe assets. So there are two streams. So my research is based on the second stream. My contribution on the existing literature, first of all, I create novel media sentiment indices, media pessimism indices. I use the Wall Street Journal and Seeking Alpha data, articles from Wall Street Journal and Seeking Alpha, and I link these indices to the time-varying stock and bond co-movement. My second contribution is that I introduced the media disagreement, and I use this disagreement as a proxy for narrative heterogeneity. So I used this disagreement, and I saw that this index amplifies the pessimism co-movement relationship. And finally, I estimate a conditional hedge coefficient, I estimate the conditional beta, and I use this estimated conditional beta, and I classify strong and weak bond hedge regimes. And based on these regimes, I created dynamic portfolio strategies. So now let's see the data. Again, feel free to ask me. Now I'm going to show you the textual data and how I created these novel indices. So feel free to ask me. About the market data, I use the S&P 500 returns for the period 2007 to 2023. For bonds, I use the 10-year US Treasury returns. I use the 10-year US Treasury yields, and I converted the yields to returns using the convexity and duration approximation. So I calculated the stock and bond, the 22 trading days stock and bond correlation. And now on the other side, the textual data. So for the textual data, I used two different sources, outlets. I used the Wall Street Journal as a traditional source. And on the other side, I use the Seeking Alpha. The Seeking Alpha is a platform, investor platform. Everyone can write our opinions in Seeking Alpha. So I used Seeking Alpha articles, again for the same period, 2007 to 2023. So in total, I used around 220,000 articles. So based on this data, based on these articles, I created two different indices, the media pessimism index and the media disagreement index. So when you work with textual data, the first and the most important thing is to do the text cleaning, the data cleaning. So if you skip, yes, I think Tolu has a, yes.
Yeah. So
Yeah,
Tulu, you can ask a question.
Yeah, I just wanted to come in here in case I don't have the time later. How the articles that you collected from Wall Street Journal and Seeking Alpha, they relate to a number of topics, not just bond and equity. Are you able to decipher which particular topics are being discussed? Because it seems as if you use the universe of articles, for example, in Wall Street Journal, even though they may not relate specifically to the particular issues that you want to capture.
Yes. So about the Wall Street Journal articles, the Wall Street Journal provides, first of all, Wall Street Journal and Seeking Alpha shared with me all this data. So when I had this communication with Wall Street Journal and Seeking Alpha, I asked for specific columns. So for the Wall Street Journal, I used the US market column. So there is a specific column in Wall Street Journal. This name changes over time. I mean, this column, you can find this column. I think that recently the name is U.S. markets, something like this. So it is a specific column that discusses about the market, the stock bonds market, the daily market. Yes. So I used specifically only this column, not everything. So I focused on these markets, the stock and bond markets, the US markets. Okay. And regarding the Seeking Alpha, so also Seeking Alpha has a specific columns. So you can use. So again, for Seeking Alpha, I used the today's market. Today's market describes what happened yesterday in the US about the stock and bond markets. And also, I asked specifically for fixed income, for bond markets. So I was very focused on this request. So I haven't used irrelevant articles.
Okay. Thanks a lot.
Thank you. So, as I said before, the first and the most important thing is the text cleaning. So I follow these specific steps. So first of all, I standardize the text. I standardize the text by doing I lowercase all the letters. I remove punctuations, numbers. So I use the plain text. Then the second step is to tokenize the words. So we have I had all the one sentence. So I used the tokenized. I did the tokenization. So each word was one token. Also, I removed stop words like the, because these words do not include any sentiment. Also, I dropped some frequent journalist terms. This step was mostly about the Wall Street Journal, because the Wall Street Journal, the journalist of the Wall Street Journal has a specific language. So it's not, it's a strict language. So I remove the frequent journalist terms. And finally, the last step is to lematize the tokens. When we say lemmatization, here I use an example. For example, here prices or price becomes price. So here I can show you an example. So this is a raw seeking alpha article, raw data. So this is one example of how and what a raw article looks like. So as you can see, it's very confusing. You cannot, there are a lot of unnecessary characters. So I need to drop all of them. So I need to clean this text. So before going to the main analysis of the text, I need to clean all these unnecessary characters. And I'm going to show you now here the clean text. Can you see? So here, this is the clean text.
Yeah. So yes, we can see it, but how did you do that? Did you do that manually, or did you follow some programs, language programs?
Yes, I only use Python programming. So to do all this analysis. So there are specific packages in Python you can use, like NLTK. So there are many different available packages in Python. So I only use Python for this analysis, and also the number of articles I had to pre-process. I mean, the number is huge, so you cannot do this analysis without any programming language. Yes. And here I also added a raw Wall Street Journal article. Again, you can see a lot of unnecessary characters. And here, this is the clean text. So after pre-processing the raw text, I used the clean text for the next steps to build the sentiment indices.
Sorry, I can see that you use single word in the analysis. Did you also consider n-gram, for example, bigram?
Oh no, single words. But I can try. Yes, thank you.
So what are the differences?
Do you want to answer the question?
Ioanna, yeah. So why are they different? Why what Tulu proposed is an alternative, and what are the differences between what you have done and what Tulu is talking about?
Yes. So Tolu, if I'm correct, you said that I use only that single tokens. And
yes. For example, if you look at the clean data from Wall Street Journal, you have treasury and yield as separate words, okay, which may not convey enough meaning. But if you combine it to treasury yield, for example, you introduce a little bit of a meaningful interpretation of the data.
Yes. So okay. The reason I did I used only the single tokens is because I used the Lugran-MacDonald the dictionary method, which so in my analysis I want to match. So for this text, you can see this clean text. So here in this text, I want to match the specific only one word, only one token to a specific dictionary.
Okay.
Is that what you asked?
Okay. I understand. Yeah, I understand what. Yeah. Thank you.
Thank you. So here, and after the cleaning of the text, I also did some time adjustments. I use the daily, the 24-hour window and aggregate by trading day. Because obviously in one day I had a lot of articles, so I had to create the daily index, sentiment index. So I aggregate the articles by trading day. And here, this is what I mentioned before about the specific tokens, the single tokens. So here, I follow the dictionary-based approach of tokens, and I used the Lugran-MacDonald lexicon. The Lugran-MacDonald lexicon is used in the finance literature. So that's why I chose to use this lexicon, and actually I use this lexicon to match my tokens, to match my articles into positive and negative words. So in one article, in one clean article, I found which of these tokens, which of these words are positive and negative. So, and that's why I did the single token. So I wanted only one token to be matched with the Lugran-MacDonald lexicon. So I calculated how many positives and how many negative words appeared in each article. So the first step here was in an article level. So I found and calculated how much positive and negative words. And then I calculated, because I wanted to make the daily sentiment, the daily index. So to calculate the daily index, I calculated first per source, first for the Wall Street Journal and then for the Seeking Alpha. I calculated the weighted average for the positive words and the weighted average for the negative words. And finally, the pessimism index was just the difference between the negative words and the pessimism words. negative and positive. I'm sorry. So the pessimism index for each article is just the difference between negative minus positive. This was
the number. You mean the number?
The number. The weighted average, because here, in this step, so here, this is the positive index for each day, okay, per source. So here, let's say, for example, we talk about the Wall Street Journal. So for each day, for today, I have a lot of articles, Wall Street Journal articles. So I counted how many positive words appeared today in 20 articles, how many, but also I divided this number of positive words with the total number of words of today, because I wanted to get the weighted average. And the reason I did that is because the length of the articles between Wall Street Journal and Seeking Alpha is different.
Yeah.
That's why I used the weighted average.
Yeah. So I allow Tulu to ask another question, because this will help all of us here.
Yeah.
Tulu?
Yes.
In case I'm not around and you got there are two additional improvements I foresee in this particular slide. The first is the possibility of using Finberg.
Oh, the Finberg.
Yeah.
Yes.
That allows you to measure sentiments at sentence level.
Yes.
Okay. Then in terms of your disagreement, I will also advise that you use more advanced measure like cosine similarity.
Okay.
I don't know if you have come across that before. Cosine similarity.
No, about the similarity, no, and I would like to discuss it with you offline.
Yeah.
And thank you for your suggestion. About the Finberg, I already I have already started doing this analysis, because the main idea here is to use the lexicon-based approach, this approach, as a benchmark, and then to test the whole analysis using more advanced methods like the Finberg. Yeah. Thank you, Tolu. So after calculating the pessimism per day per source, then I wanted to create the total pessimism index using both sources, Wall Street Journal and Seeking Alpha, and for this index. So this is my So this is the final index, which is just the equally weighted average between the pessimism from the Wall Street Journal and the pessimism of the Seeking Alpha. So after creating the pessimism for each source, then I used the equal weighted average to find and to calculate the aggregate pessimism for each day. And for the disagreement, I used just the difference between the pessimism of the Wall Street Journal and the Seeking Alpha. And I used the absolute value, because in that case, using the absolute value between the pessimism of the Wall Street Journal and the Seeking Alpha, it shows me that how much if they disagree a lot, if agree or disagree a lot. I didn't want to take into account how much they disagree, how much exactly they disagree. So I used the absolute value here for the disagreement index. Here, this is the graph of the pessimism index. So I highlighted some periods where my pessimism index is elevated. For example, here during the COVID period. So you can see just before the COVID, we had a decreased pessimism index, and suddenly during the COVID period here in 2020, we have an increased. Or another period is, of course, during the global financial crisis. So you can see that the pessimism index follows the market, the uncertainty of the market, the mood of the market. Or here, after the 2022, here we have again an increase in the pessimism. So here, which is the inflation period. So before going to the main model and the main analysis, I built intuition. So I do a subsampling analysis to check if my pessimism index captures the flight to quality pressure. So the logic behind this analysis is that if the pessimism index captures the flight to quality pressure, we should see equities perform worse, bonds perform better, and the correlation become more negative when the pessimism rises. So I wanted to see if there is any pattern in my data. So here I study two specific questions. The first one is a contemporaneous channel. So in the first sampling analysis, I asked, do daily changes in media pessimism line up with differences in same-day stock and bond returns? And the second subsampling analysis is a forward-looking channel. In this analysis, I check if the level of media pessimism predict future stock-bond correlation. So let's see about the contemporaneous. So here, the process I follow here is, first of all, I calculated the delta pessimism. So I got the first difference of the pessimism. So here, when the delta pessimism was negative, in that case, we have a big decrease in the pessimism when the delta pessimism is negative. And on the other side, when the delta pessimism is positive, in that case, we have a big increase in the pessimism day to day. So I will show you this table, and I will explain you what is this table and where is the pattern here. So here, first of all, the pattern I discover in my data is that the pattern is consistent with the flight to quality. So the main patterns are here. So we can focus on these percentiles. We can focus on the tails here, the fifth percentile, and also in this percentile. I forgot to just to describe what is this table. So here, this is the mean value. This column here is the mean value of the bonds and the standard deviation, this column. And this column is the mean value of the stocks and the standard deviation of the stocks. And the last column is the returns between bonds and stocks. So, two main patterns here. Bond returns here, this column, bond returns peak in the tails. If you see here in the 5th percentile and here, 95 percentile. So you can see that the returns, the bond returns, peak in these two tails. So here, the returns in the 5th percentile, the returns 0.049% and 0.066%. So,
Ioanna,
yes.
For this last column, can you explain, is this the correlation coefficient or is this the
No,
test, the t-test?
Yes, this is the rolling stock-bond correlation.
Okay, so stock-bond correlation, and this is simply, it's something like the estimated the correlation between bond market and the stock market. If you regress the stock market on the bond market, this is your coefficient. Is that true? So this is the impact of the bond market on the stock market. So on the stock return, let's say that way.
So the coefficient represents the co-movement.
Yeah.
So this column, the last column here, is the calculated, not the estimated, is the calculated 22 trading days rolling stock and bond correlation. It's not. Yes, it's not an estimation here. It's a calculation.
Yeah, no causal, but the correlation. But you said you compared them, but where is the statistics showing the level of significance? Or do you need that at all?
Okay, so I haven't introduced yet the model. So far, in this analysis, this is a sub-sampling analysis. So I haven't introduced any model yet. I only wanted this is a preliminary analysis. So before going to the model, this is a preliminary analysis to see and to check if there is any pattern in my data.
Yeah. So
without any model.
Yeah, Ioanna, because they are all negative, so we can conclude that when when your pessimism index increases, then they are moving in a negative direction, so that a bond can be used as hedge.
Exactly. Okay. So here, if you focus on the last column, on the correlation, you can see that the stock-bond correlation here is substantially more negative when pessimism increases.
Okay.
So when pessimism is, when we are here in the 95 percentile, the correlation is the highest here, the more negative.
Yeah.
So from minus 0.44, we go to minus 0.59. So the correlation becomes more negative. So there is a pattern here. The higher the pessimism, the higher the correlation becomes more negative. Without any model, without any estimation here. Okay?
Yeah, that's fine. And yeah. So this is only the pattern, but there is no causal relationship.
Yes.
No. Okay.
So
okay. Yeah, let's go. Yeah.
And the second subsampling analysis is about, again, no estimation so far. So I did again the subsampling analysis, and I checked the forward-looking correlation. So I just created the correlation. I used the correlation, and I moved the correlation 22 trading days forward. And I got the pessimism, my pessimism index, the lag one. And again, I did here a subsampling analysis. So here we focus on the average, this one. This is the 22 trading days stock bond correlation. So if you focus again on this column, on the average column, we can see that the pessimism here, as pessimism increases, the correlation becomes more negative. So if you see, if you go, you check the last row here. In the last row, the pessimism, my values are less than minus 0.6, which means the pessimism here gets negative values. So the pessimism is very low. So we talk about an optimistic environment. So if you go, so here in this optimistic environment, the correlation is minus 0.41. When we start increasing the pessimism here, if you go up, and let's focus on here, pessimism higher than 0.7 here in this row. That means the pessimism gets a lot of positive values, so that the environment is very pessimistic. So here you can see that the subsample, the correlation becomes more negative. So from minus 41, we are in the minus 54, 0.54. So again, we can see a pattern. The higher the pessimism, the more the correlation becomes more negative. Okay? So, sorry. So now I move from descriptive analysis to a structural empirical framework. So here I follow these 4 steps. The key thing here is that I'm not trying to forecast, I'm not trying to predict stock or bond returns. But instead, I'm trying to model the conditional co-movements. This is very important. So these are the 4 steps I follow. So the first step is to check whether returns on bonds and stocks are predictable. The second step is to estimate the conditional co-movement model using the media pessimism, the media disagreement, and also the recent stock and bond correlation, realized correlation. The step 3 is to use this co-movement, this beta, to use this beta and to turn the conditional sensitivity into strong and weak hedge regimes. And finally, I did some robustness checks, my results. So the first step, the unpredictability of bonds and stock returns. So as I said before, the first step is to check if we can predict the bond and stock returns. So here, the answer is that we cannot predict the returns under the efficient market hypothesis. New information is immediately priced, so we cannot predict the stock and bond returns. So here, I tested this predictability. So this is the 2 models, the bond returns. So for bond returns, I used my pessimism index. I used the lag 1 pessimism index. I also included in my model the bond returns of using 5 lags. And also I used the stock returns, 5 lags. And I also used the correlation, the realized correlation, but I used the lag 22. So I used the previous period correlation. And the reason I used this correlation is because I wanted to avoid data overlapping. And that's why I used the last period's correlation. I did exactly the same for the stock returns. And the results for this analysis was as expected. the R square was very low, 1.1% for the bond returns, and around 2.9% for the stock returns. And even if I had some variables like the bond lagged bond returns and stock returns are statistically significant, the overall R square was very low. So we can note it's very difficult to predict directly the stock and bond returns. So this is the
and they are all negative, right? They are all pessimistic index is negative.
Yes, yeah, the coefficient, yes, was negative, but not statistically significant. So about the direct, when we direct when we want to predict directly the stock and bond returns.
Mm.
So this is the core model. So I regress bond returns here, the bond returns on the stock returns, but here allow the stock to bond sensitivity, this beta. This is the Hedge coefficient. This is the most important thing of this analysis, this beta. So I allow the stock to bond sensitivity to vary over time, and to vary over time as a function of the pessimism, the disagreement, and the recent stock and bond correlation, because also we care about the macroeconomic environment and also their interactions. So in plain terms here, the question is not, do bonds hedge? So I'm going back to the beginning. The question here is not do bonds hedge, but how much do they hedge today, given the media tone here, the media tone and the disagreement between two different media sources. So this beta is the time varying hedge coefficient. More negative beta, stronger hedge. Closer to zero or positive beta. In that case, we are under weak hedge regime. So we have weaker bond hedge. I also stand up for
Ioanna,
yes.
I have a question on this
Yes.
model. I saw some time ago, I remember I saw a paper from NERC, and they surveyed this call movement literature, and they ran stocks against the bond. So do you see any differences here? You are running bond against the stock, and there they call the movement coefficient as alpha, and of course you call this beta. So what are the differences between those two models?
The main difference is this one, the pessimism. The pessimism and how I created this pessimism.
Okay, so my question is, why did you not run stock market against the bond?
Yes, because the pessimism index, in my analysis, I assume that the pessimism index, the first effect is on the stock markets and not on the bond markets. So this is the first effect. And so the pessimism, the uncertainty, this uncertainty is mostly about the stock market and not about bond market. So the first effect is on the stock market, and then I check how this uncertainty on stock market, this effect on stock market, goes to the bond market. So how, if the bonds go closer? Yes.
Yeah.
I think we have a question.
Yes. Hi. Can you hear me?
Yes.
Yeah. Do you have any momentum in the return data? So we have daily values. I was just thinking that if there is momentum here in the return data, that could be enough to build a hedge strategy. And then maybe your pessimist index is not adding anything. Yes, I know it's a massive question, but have you checked for these possibilities?
I did. I saw some interaction. A little bit noisy. Did you hear the question, Ioanna?
I was trying because the connection was not very well. So did you
Okay.
ask me about the interactions, these terms?
Yeah, first of all, if you have any momentum in the data, and if the momentum here itself could be used to build a hedge strategy.
It is still not so clear. I do not know why the
Well,
connection is not good
I
today.
am in a public place, that's why.
Oh, okay.
So you asked me about something about the momentum.
Yes.
Would you like to
elaborate?
The momentum in the return series could be used then to build a hedge strategy. So that could be enough, and then your pessimistic index is perhaps just picking up some momentum in the data. Yesterday was a bad day on the market, therefore now people have a pessimistic view about the future when they write today.
But how do you normally measure momentum, Bo? How do you?
Yeah, for autocorrelation in the return series.
So the autocorrelation. Did you say you controlled the lag of the bond and the stock market as well, right, Ioanna?
I used in my model the bond returns lag 1. Yes, here. I already include that.
Yeah.
But not for the stock returns, only for the bond returns.
Okay.
But it was not it's not statistical, it's not significant. Yeah. But
So the question is that your pessimism index actually overlaps with the momentum of the market. I think here probably it's more on the stock market momentum.
Do you mean the joint determination of the two, of the stocks and bonds?
The historical performance of the stock market, for example? Did you mean that, Bo, right? Your question refers to the stock market.
Yeah, exactly.
Yeah. So anyway, this is something probably we can discuss further if you so you did not control the actually the historical, or I do not know how many days that you controlled the stock market performance. But so let's continue for this moment and see where we can go. Yeah, thank you.
So here, these are the main results. So let me show you the table here of the analysis. First of all, I did the analysis, the model 1 and model 2 with and without the pessimism index, because I wanted to see if we can increase, if the pessimism adds something to the model. And indeed, the model 1 is better in explaining this co-movement. So what we have here, first of all, the baseline stock to bond relationship is negative. This one, the stock to bond, this is the baseline, consistent with safety demand. The second here, the pessimism, this coefficient, the pessimism significantly strengthens the hedge. You can see the coefficient becomes more negative when the pessimism is high. It's higher. And finally, third, the disagreement. Here, the disagreement amplifies this effect. So when pessimism is high and narratives between Wall Street Journal and Seeking Alpha diverge, the hedge becomes even stronger. So the intuition here is so about the beta. This beta, so more negative beta. We are under a stronger hedge regime. So the pessimism increases the risk, the perceived risk. So as a result, we are the demand for safety is stronger, and as a result of all this, the bonds move more oppositely to stocks. Also, the disagreement captures all this uncertainty. So when both the pessimism and disagreement are high, the flight to quality channel increases, strengthens. So putting all this together, overall, the pessimism when pessimism increases, investors demand safety. So bonds move more opposite to stocks overall. Also, when disagreement is high, the uncertainty is higher. So again, investors demand safety, and bonds move more opposite to stocks. Finally, the market state matters also. When I say market state, I mean the recent realized stock and bond correlation. So the hedge effectiveness is not constant, but a function of the narrative tone, and the disagreement, and also the market conditions. So after estimating the model, and so I have specific coefficients, I calculate this beta. I used the coefficients of the model, of the main model, and I calculated the beta. So I used this beta to classify the hedge regimes. So the threshold I used to classify these regimes is the median. So I used the median of this beta, and I classify these two regimes. So every the values, the beta, less than the median, we are under strong hedge regime. And values, when beta is higher or equal than the median, we are under weak hedge regime. Why media split? Why did I use the median? Because avoids the arbitrary cutoffs, and I also had exactly the same number, the balanced regimes. So the interpretation of this, the economic interpretation of these two regimes. So the strong heads, we are under strong heads when the pessimism and the realized correlation are aligned. In that case, the beta becomes more negative. And the weak hedge regime, we are under weak hedge regime when the pessimism and correlation are misaligned. So in that case, the beta are closer to zero or even negative, positive. So here is the graph with the regimes. This is the beta historically, the calculated beta, where the red are we are under weak hedge regime, and the green one we are under strong hedge regime. Yes, Bo.
Because now we have seen your key result, and that is one pessimism index increases, and that means more risky situation, more uncertainty, and then bond market, the hedge effect is stronger, right? So we can rely on the bond market to hedge if the stock market is becoming more risky. So we did not find the call movement. We found the negative connection between those two markets, which is good news for investors. But just before your presentation this morning, I checked the stock market and the bond market movement, and there is a pattern after 2020. So we were in the negative domain, and then the American market, the call movement, they go to the same direction. So it is becoming positive or positively connected, or the less hedging effectiveness of the bond market when we have this Ukraine war, when we had this. So it's more uncertain. So how do you explain this? So I'm making the connection between your key conclusion, the result, and what we are seeing, the pattern here after COVID, after 2020, 2022, we see the positive. So that implies the hedging, the bond market is less effective for investors to use as a hedge.
Exactly. And especially in 2022, there was no hedging because the correlation turned positive. So there is no hedging here.
So why is that? But we have a lot of uncertainty, have we?
Yes, but at the same time, that's why I mentioned before there are two streams: the macroeconomic explanation of all this effect on the correlation, and on the other side there is a behavioral stream.
Yeah. So you focus on behavioral. So your fundamental theory is the behavioral finance. I agree, but if you follow behavioral finance, you should control the fundamental before you check the impact of behavioral. So did you, and this is something that I wanted to ask you actually earlier. So did you consider the fundamental factors when you are following the behavioral direction? So you are pessimistic. You just mentioned a diagram. You say, okay, this is when inflation is too high, and your pessimism index increased along with the increase of high inflation. To me, inflation is fundamental, and so you basically, to me, I'm becoming more optimistic because I see the economic situation is becoming better. Otherwise, I'm more pessimistic because I see inflation is too high, cost of living is too high, etc., etc. So the behavioral aspect to me is connected with the fundamental. So having said that, I'm considering whether or not you need to consider the fundamental factors, control them in your empirical model. What do you think about that?
Yes, I agree. But when we discuss about the correlations and what are the fundamental variables that affect the correlations, we think about the inflation rate, interest rates, or the growth rates. So in my analysis here, I included here in this, let me go back. So here in my model, I included also the realized correlation. And you see the realized correlation. This is the calculated correlation, the realized correlation, not the co-movement. the realized correlation. So, which assume that the realized correlation represents the macroeconomic environment in my model. So in my model, I included the pessimism index, the behavioral factor, the behavioral variable, and also included the realized correlation, which
So
reflects,
you control the
yes,
for the
which reflects the macro environment.
okay. Yeah, so you justified the impact of your index. I can see that. Yeah, fair enough to me. So, Ioanna, do you have any contents to finish? Can we finish it now? Sorry to interrupt you, but yeah.
Yeah. So yes. So okay. So here, okay, we also I predict after defining the strong and weak hedge regimes. I used the linear probability model to forecast these regimes here. So I used I actually, because this is what it's very important to predict the regimes. So I used the predicted regimes. The two robustness checks I did was first of all, the first concern is if the pessimism index includes some fiscal policy narratives. So if investors are pessimism because of the fiscal policy, the meaning of the pessimism is totally different. So we expect that the higher the pessimism about the fiscal policy, the bonds do not act as, I mean, it's totally different. So I checked if in my sample, in my articles, there is any topic about the fiscal policy. So I use the topic modeling and I check the narratives, and I found that there is no fiscal policy topic in my sample of articles. This is the first robustness, and the second one is about the joint determination of the stock and bond returns and the volatility. So I removed the mean and volatility dynamics. I used the AR1 for conditional mean and a GARTS1 for the conditional variance. I computed the standard data shocks for stocks and bonds. And then I defined the co-movement as the product of the shocks, the shocks in stock market and shocks in bond market. And I regress again the co-movement, the product of the two shocks here, and I use the pessimism index. And I found that the pessimism index was statistically significant and negative. The coefficient A1 was negative and highly statistically significant. Very quickly, so far the daily returns unpredictable. So I focus on the conditional co-movement. The conditional beta pessimism strengthens the hedge. Also, the disagreement matters, and also the recent correlation condition the effects. So the beta provides very practical basis for we identify strong and weak hedge regimes. I forecast the regimes, and also I use these regimes to do the portfolio, to construct the portfolio strategies. And now to the application of my analysis. So here, the main and the most important question is that which position should investors take under the weak hedge regime? Because under the strong hedge regime, we know that bonds act as a good diversifiers. But what is going on under weak hedge regime? So this is the main question here. So under weak regimes, bonds no longer provide the expected protection, and the diversification breaks down. So investors are most exposed. So here, first of all, I calculated 10 portfolios, static portfolios under each regime. So here, let me show you the graph. So the orange line is under the strong regime, blue line under weak regime. In the x-axis, I used different bond weights, and also I calculated the annualized Sharpe ratio. So as you can see, under strong regime, the equally weighted portfolio here, the 50-50, gives me the highest Sharpe ratio, annualized Sharpe ratio. And under weak regime, and this is our focus here, under weak regime, which position should we take under which weak regime? You can see that in most of the weights here, most of the portfolios give us negative Sharpe ratio. So this is the question here: which allocation should we take under weak regime? So here the decision problem, when the bond hedge is weak, investors face higher joint risk. Stocks and bonds do not offset each other. So here we have the maximum exposure. So in strong regime, the data suggests 50-50. So based on the analysis I did before, using the Sharpe ratios. So under weak regime, I test two different portfolios, a defensive portfolio and aggressive. So the defensive portfolio, I shift fully into bonds, and the aggressive, I shift fully into stocks. So here are the two strategies. The conservative strategy, move to bonds in weak regime. So under strong regime, go and allocate 50-50. And under weak regime, move entirely to bonds. This is the strategy one. The strategy two is the aggressive strategy. Under strong regime, allocate 50-50. Under weak regime, move entirely to stocks. And also, I use the benchmark, the static strategy, 50-50. No matter, it doesn't care about the regimes. Allocate your money 50-50. So first of all, I implement this analysis using the predicted regimes and not the actual regimes. So here, let's see the performance table. Clearly, the strategy one outperforms the strategy two and the static 50-50, the equally weighted. The annualized returns around 8%. And also, this strategy gives me the smallest risk, the standard deviation, the annualized volatility. The Sharpe ratio also is the highest, and finally the maximum drawdown, the lowest maximum drawdown. So clearly, the strategy one outperforms the equally weighted and the strategy two. So remember, the strategy one is under strong regime, 50-50. Under weak regime, go entirely to bonds. So the answer to the main question is that when the hedge regime is weak, the evidence, the analysis favors a defensive position. So shift fully into bonds rather than increasing equity exposure. And the intuition of this portfolio allocation is that weak regimes are precisely when diversification fails. So we avoid equity exposure. When we avoid equity exposure, we reduce drawdowns. The conclusion, bond hedging is state dependent. The stock to bond movement varies over time, so it's not constant over time. The media tone, the media sentiment matters a lot. The higher the pessimism is associated with a more negative stock to bond relation. Also, the narrative disagreement matters too. The disagreement amplifies the effect. And also some practical implications about the conditional beta. This beta helps identify strong and weak regimes, and investors are most exposed in the weak regime. So when we are under the weak regime, a defensive shift to bonds is better rather than increasing equity exposure. Thank you.
Ioanna, that's a really good paper. That's my first reaction.
Thank you.
And I can see a lot of potentials here. For example, for the last bit, you applied your result, you constructed the portfolio, and you tried by using the predicted regime, etc. But you can try them with the real data, maybe, and see whether your prediction or your result is in line with the real market data. So I also like that you made the underlying theories very clearly. So we are basically, I forgot which year, but maybe I think 10 years ago. So Fama French and Professor Sheila, they both got a Nobel Prize, and those two fields or two representative scholars that they have been fighting for the whole career life. I mean, one is efficient market hypothesis and the other is the behavioral finance. So I think in your research, you actually combined both, and this is something that I think is very interesting aspect. And also your measurement of the media, the pessimism index. And I'm sure I'm not an expert in text analysis, but I can see it contains a lot of logic, and it is convincing by using the large language models. So overall, I think it's a good piece of research, and you just defended your degree, and that means the work is quite comprehensive to me. Well done, and many congratulations.
Thank you.
So I can open the floor to the audience and see whether there are some more questions. And we already had some discussions from my side, and I would like to see whether we have more questions on the floor or in the audience, please. The disadvantage is, Ioanna, is that we are a little bit over the regular time, but that's fine. I enjoyed it very much, and I think you did this very, very calmly, so no matter what question you got. So if there is no more question, can I ask again, do we have any more questions? If there's no more, Ioanna, I gave you one sentence or two to finish your presentation today.
Yeah, I would like to thank you so much, because this is very important for me. I'm in my early stage career as a researcher, academic researcher. So yeah, I wanted to thank you so much for this opportunity to present my work and to give me
It's
feedback.
very interesting. Yeah, thank you. So thank you very much, Ioanna. Let's keep in touch. And you worked with me before, so you know me. We know each other. And keep in touch. If you have any questions, just send me a message.
Okay.
Okay, so in that case, I thank everybody who is so patiently listening to us, and we can close this session. It's a little bit technical, but it's so interesting. So thank you, everybody. I'll see you next week.